The biggest financial institutions on Wall Street are currently pouring billions of dollars into a technology specifically invented to bypass them. Think about what happens if you want to send money to someone in Tokyo on a Sunday. You can't just hand them cash. You ask your bank for help. Your bank talks to another bank, which talks to a payment network across international borders. It takes days to clear and costs a percentage. This diagram shows how our current system relies on a centralized middleman. Your bank keeps a private ledger, a master list of who owns what. Meanwhile, a central government controls the overall supply, printing new currency whenever they decide it is necessary. In 2009, an anonymous programmer using the name Satoshi Nakamoto created an alternative. Nakamoto built a system that uses a public ledger instead of a private one, and a strictly fixed supply of money. Bitcoin operates as a financial network where unchangeable mathematics replace the authority of a central bank. To make this system work without a bank sitting in the middle, Bitcoin relies on a piece of technology called the blockchain. Instead of a single bank holding a private ledger, millions of computers simultaneously share and update the exact same transaction spreadsheet. New transactions are batched into blocks. Before being permanently added, the global network must inspect and agree every transaction is valid. To validate that block, these computers frantically race to solve a complex mathematical guessing game. This system is called proof of work. Because the verification process is spread across the globe, anyone trying to hack the system or fake a transaction would need to physically control over 51% of all the computing power on Earth. By distributing the work, the blockchain acts as a decentralized trust machine. It removes the single point of failure you have when one central bank controls the records. You might wonder why anyone would spend massive amounts of electricity and computing power to validate these transactions. The answer is the reward. The winner of that math race earns newly minted Bitcoin. On one side, traditional currency is printed continuously. On the other side, Bitcoin has a strict 21 million coin cap. As this structure evolves, a mechanism called the halving systematically cuts the reward for mining new coins in half every 4 years. During the most recent halving in April 2024, the reward dropped to just 3.125 Bitcoin per block. The flow of new supply entering the market is constantly shrinking. Financial institutions treat Bitcoin as a digital version of gold because its scarcity is enforced by code that cannot be printed away by a government. There are thousands of other cryptocurrencies out there, commonly known as altcoins, and they serve different technological purposes. While Bitcoin is primarily designed to be a secure store of value, networks like Ethereum function more like global supercomputers, built to run complex digital contracts and applications. This chart breaks down the total value of all crypto assets currently in the market. As you can see, Bitcoin represents roughly 60% of the entire market. Its 15-year track record and heavy institutional adoption maintain its status as the dominant force. For a long time, investing in this space meant wiring your money to unregulated offshore exchanges and managing your own complex digital passwords. The dangers of that early era became clear in 2022. When the FTX exchange collapsed, billions of dollars in customer funds vanished overnight. The risk of losing everything sat entirely on the shoulders of the individual. That risk profile shifted in January 2024, when the U.S. government approved the first spot ETFs, investment funds that hold actual Bitcoin and trade on the stock market like regular shares. These funds, like BlackRock's IBIT, allow regular people to buy Bitcoin exposure directly in their standard brokerage accounts or Roth IRAs. You no longer need to manage the underlying code or risk a private exchange to own the asset. Even with its new institutional packaging, Bitcoin remains a volatile asset capable of massive price swings. This pie chart illustrates a grounded portfolio strategy. Rather than treating a Bitcoin ETF as your core holding, you carve out a conservative 2 to 5% slice for diversification. You capture the growth potential without gambling your entire financial foundation. The golden rule of crypto investing is simple. Position sizing is everything. You should never allocate more capital than you can afford to watch drop by 80% and still sleep soundly at night. Bitcoin began as an anonymous experiment. Today, it is a mathematically governed asset that has become a permanent fixture in modern finance.